हाँ बिल्कुल बेटा, ट्रॉली ला के ये भी निकाल दो।
And one is in Boston.
Nokia का upper end का complicated.
Family houses and individual investors. We are here today to provide a broad investor spectrum, the opportunity to interact with the management of the company. We will shortly commence with the presentation given by Mr. Rahim Mohammed, CFO of Engro, followed by a Q&A session chaired by Mr. Asad Umar, CEO of Engro, and Mr. Rahim Mohammed, CFO of the company. This will be followed by concluding remarks made by Mr. Junaid Iqbal, CEO of BMA Financials. We are proud to present this joint event with Engro Corp, one of the fastest growing and only multinational conglomerates from Pakistan. The company reported a turnover of rupees 80 billion and net profit of 6.4 billion in 2010. It is investing in all the right sectors, the high growth sectors of Pakistan, including food, fertilizer, petrochemicals, energy, as well as trading concerns. With my background in the investment community, I would also like to say that Engro has been one of the pioneers in terms of providing a multi-asset approach for investors across the retail and corporate and institutional spectrum. We've had Engro Rupiah, and with the listing of Engro Foods, we've also had a chance for investors, equity investors, to come into one of the highest growth areas in Pakistan as well. Now I'd like to give the floor away to Mr. Rahim.
Sorry, my voice is a bit not performing well today, but just excuse me. It's a short presentation, it will take more than 15-20 minutes. What I've tried to do is that the earlier part of the presentation is giving a little bit of background on what we've done in the last few years. Some of you may be very familiar, but since we have a wider audience, I thought we'd give a little background. And then we come to some of the questions that you may have in your minds, which keep on popping up in the investor community regarding gas, debt, etc., to tackle that. So, starting with what we are, Engro Corporation today is basically a holding company, and the businesses which it owns is across a diversified different businesses and different economic sectors, but the industry which we have chosen we've chosen in such a way that they will tend to perform even when the economy is not doing that well. And if you look at the key sectors we have, for example, fertilizer is purely agri-driven, so even if there is, let's say, a recession in the urban areas, that demand for fertilizer will still remain and will continue to perform well. Take power, which is, we have a chronic power shortage in Pakistan. So again, irrespective of how the overall economy is doing, the power business will continue to thrive. Even in the food business, we are into very defensive, basic commodities like dairy, etc. We've given a snapshot of how much we have invested in the last 5 years. The biggest one being fertilizer, again, to cater for the growing demand of urea in Pakistan. And then we have into petrochemicals, power, food, etc. 2010 highlights are with you. at 80 billion rupees with a profit after tax of 7 billion, a market cap as of 30th June of 64 billion rupees. If you've seen these numbers or circles or globes, whatever you like to call it, if you see a 20-year history, we've grown from a 1 billion rupee revenue company to 80 billion last year, and this year will be obviously substantially more. An after-tax profit of from about 100 million rupees to 6.8 billion last year. Same with the asset size. If you see the revenue has gone 80 times, after-tax profit 70 times, market cap about 23 times. So we've demonstrated as a constant growth track record over the last 20 years or so, and significantly more in this last decade or so. I'll just give you a brief snapshot of each of the businesses so that you understand and we can go on to the bigger ones as such. In foods, what we've done is, in the last 5 years, started in 2006, we've gone from a turnover of 1.6 billion in 2006 to 21 billion last year, and this year we're targeting about 30 billion. We had some initial losses because we were spending aggressively on brands, on supply chain infrastructure, but now that we've reached the economies of scale, it is profitable. In fact, the dairy segment was profitable from 2009 as a company. We are profitable since 2010. Now we have market leadership in processed milk, the UHT segment, and in ice cream we are a solid number 2. In fact, our market share is around 20% now in ice cream as well. We continue to grow in this business. We will expand into more geographical areas. We will add product lines like powders, grow existing market share, and we also have some plans to go offshore. We've acquired a very small company in North America dealing in halal food business, and once we grow that a little bit, that will create a base for exporting more products out of Pakistan as well once we have the distribution channel available. Within the foods business, we've also set up a rice processing plant, but that is more right now being handled by another company called Engro, which will be procurement and export. So we call it more of a B2B business. Maybe sometime in the future we might add it to our consumer segment as well. Power generation. We completed this power plant which started in 2007 last year. It's almost now 15 months since we had commercial operations. It's a very unique project utilizing low BTU high sulfur gas which was previously being flared. And if you just take the economic cost of that power generation, it's about ₹80, which is about 1/10 the cost of a furnace oil power plant, simply because of the fact that that gas was being wasted. And if you take it from a country perspective, the effective cost of that power generation is probably the lowest, even lower than probably hydropower as well. The nature of the business is such that you get very steady returns, dollar-based equity returns, and those returns are also guaranteed by the government of Pakistan. In polymers, we were initially just making PVC, which was a one-stage value addition from VCM. We recently completed the back integration as well as the expansion and added caustic soda as an additional byproduct into it, thereby increasing the overall margin for the entire chain. This year should be since they just completed COD last year, so this year should see significant gains in the operating margins as such. Moving on to fertilizer, where I believe the major interest would be. So now just to explain, we have two plants. One is our own plant, which is based on marine network and is actually medium BTU gas that is not given into or not supplied into the grid. There is only one external customer, which is the Kudu power plant, except that it is all being shared by fertilizer plants. So the curtailment levels are currently around 8-9% or so. and that has been throughout for the last 15 months or so. The other plant, the expansion plant, which actually we completed December last year, but due to some gas issues with the gas load shedding, etc., we finally reached commercial operations in June. This plant is this single train, in terms of single train, is the largest plant in the world, and within Pakistan and in fact worldwide the most efficient in terms of fuel efficiency, which is the more costly fuel. It is significantly lower, probably less than half of other existing plants in Pakistan. The other important factor is that its feed gas price is fixed for 10 years. Although the gas contract itself is for 20 years, the feed gas price is fixed for 10 years. So effectively what happens is that when the government does raise feed gas prices, the industry will raise the price accordingly. But the new plant will get the benefit because its margin will improve because sales price has gone up but the cost of gas has not. So that is a sort of a kicker in the whole equation here. Now, moving on to what the issue is and some of the questions you may have on these issues. Currently, if you look at the gas supply situation in Pakistan, largely as a result of some projects getting delayed as well as delayed imports of LNG, pipeline, etc., we have a shortfall in the country with various sectors fighting over the same gas. In terms of absolute number, if you look at from a country-wide basis, it's about 20% or so. But because certain provinces have opted to invoke an article of the Constitution 158, which provides that the gas which is produced in a particular province, that province has the first right on that gas. With KPK and SIN invoking that, the majority of the shortage is coming on the Punjab network. And our contract for the new plant is SNGPL. There, the shortage is something like 40%. I'll come to you on the mitigation measures, but just to complete the slide, what the government is trying to do and these are slightly 2 to 3 year solutions, is to expedite LNG. The new tender which has come out, so again, by the time it comes in, it could be 18 months or 24 months. Then there were existing gas fields which are already discovered, but they haven't been their gas processing facilities and then being connecting into the grid was delayed due to litigation, but now being expedited. So both of them together will alleviate the situation somewhat in the next 18 to 24 months. So this problem of shortage, at least from a physical perspective, will continue for the next 18 to 24 months. So what have we done to mitigate this specific situation we are in? And that is purely from the main mitigation we have is really a commercial issue. If you look at how we price urea, and this has been done historically because of the feed gas subsidy that was being given for the last many decades, I imagine, that our price today is just 40% of international landed price. So effectively we are giving a 60% discount when selling the urea to farmers, and in fact over the years we've actually given billions and billions to farmers. Even if you exclude the feed gas subsidy part also, the number is huge. It was something like 50 billion about in 2008 and it was something like 20 billion last year, which the industry continues to pass on the benefit to the farmer. So the point I'm trying to make is from a commercial perspective, there is a lot of pricing power available to recover whatever lost margins we face due to gas curtailment. So what we did was that the first curtailment that was announced on the new plant was end of December, when an ECC decision was taken that there will be a winter curtailment of 45 days in January-February time frame, and then for the rest of the year, the new plant will only get 80% gas and not be 100% allocation. So we increased the price by 190 rupees, and when we faced subsequent shortfalls in the gas supply, we raised the price again by another 60 rupees a bag. So we have already priced it on an annualized basis a 90-day shutdown plus a 20% curtailment for the rest of the year, as well as the small curtailment we are facing at the Mari network as well. Even then, the price, as you see, is just 40% of imported price. As we go along, and if we do face more curtailment as such, we will then obviously take appropriate pricing actions to recover that cash flow or the margin which we have lost. The next price increase, which was due July 1, we were just waiting for actually the gas price increase, and after that we will take the appropriate action as such. In addition to the commercial action, which is obviously our strongest point, we have also taken support from the court